Good morning. Let's talk about bank loans versus non-QM loans versus DSCR loans versus SBA. Which one's going to fit your situation? And most borrowers don't have a loan problem, they have a fit problem. And as a mortgage broker in Katy, Houston, and across Texas, I don't push products, I structure solutions. And the key is matching the right borrower profile with the right underwriting model. So let's break down the framework a little more clearly for you. So first is traditional bank loans. We got conventional and agency options. And those are really best for, say, W-2 income borrowers and owner-occupied primary residences and folks with strong credit profiles and documented tax returns. And how it works is traditional bank loans, say through Fannie Mae or Freddie Mac or just traditional bank conventional, are going to rely more heavily on actual reported tax return income, your W 2 income, and your debt to income ratios, DTI. But also, they look for stable employment history. And some of the strengths of that product are that they're going to offer some of the lowest rates. They offer long term fixed options. And really, there's no exotic structure. Some of the limitations are tax return write offs could hurt your qualification. It's a little tighter for self-employed borrowers, and there are more strict DTI guidelines. And if you're salaried and buying a primary residence, this is usually your cheapest capital. So number two is non-QM loans, and these are best for self-employed or complex income. So self-employed borrowers are usually the best fit, but also 1099 earners, gig economy earners, and business owners with large write-offs, but also high income professionals as well. And how this works is non-QM it stands for non-qualified mortgage. And those loans allow for alternative income sources. So bank statements for income. We can use just your 1099 income. There's also asset depletion programs. And instead of relying strictly on tax returns, we use alternative documentation to determine your income. So what are the strengths in that? Well, there's a little bit more flexible underwriting. There's generally a little higher DTI tolerance, and it works well for doctors, dentists, consultants, and entrepreneurs. Some of the trade-offs, though, are that rates are typically a little higher than the conventional loan options. But if your tax returns show low net income because of aggressive write-offs, this may be the only program that actually works for you to get your home. So there's DSCR loans, and these are generally for real estate investors. These are available for 1 to 4 unit investment properties, for BRRRR investors, for portfolio builders. They're also great for cash out refinance strategies. And how it works is your DSCR, and that's your debt service coverage ratio, is your main qualifying thing. So instead of qualifying you based on your personal income, the lender is going to qualify the property itself. And if the rental income covers the mortgage payment, usually 1 to 1.25 DSCR or better, you're going to qualify. And the strengths is there's no personal income verification. It's great for helping investors scale, but also great for cash out refinances. Some of your limitations there would be there's a little higher down payment, usually 20 to 25%, and there's slightly higher rates than a conventional bank option. But for investors in Houston, Katy, and Fulshire, DSCR is often the clearest path to scale your investment portfolio. Number 4 is SBA loans, and these are for owner-occupied commercial property. And business owners buying their own building are a good fit, but also medical office buildings for their owners, for retail storefronts, for industrial owner users. So within SBA, there's the US 7A small business loan, and there's also the SBA 504 business loan. And both will allow for as little as 10% down in most cases. And some of the strengths here are that you're going to have a low down payment, long amortizations of 25 years, and competitive rates. And some requirements are business financials. It will require a personal guarantee. and you need to be an owner occupant, typically 51% or more of the building. And if you own a business in Texas and are paying rent, SBA financing can convert that expense into equity for your own personal wealth. And the real question isn't rate, it's structure. And here's the decision framework. So we really need to look at the borrower type, the property type, and whether it's a best fit. So if you're a W-2 employee and it's for a primary residence, a conventional bank loan. But if you're self-employed for a primary investment, non-QM. Or if you're an investor, DSCR. Or if you're a business owner, think commercial SBA. And the wrong loan structure can block your future refinance potential, but it can also create unnecessary prepayment penalties, and it could limit your portfolio growth. But what they all do is increase your long-term capital costs. So the right structure creates flexibility, and that's part of the decision. So why this matters in Texas? Well, Houston and surrounding markets are capital driven. So whether you're say a first-time home buyer, or you're a doctor relocating for the nearby hospital systems, or if you're a BRRRR investor, or if you're a business owner that's looking to buy your own building, your loan strategy affects your 5 to 10 year trajectory. We operate Medallion Funds as a brokerage platform, meaning I get to shop lenders to match to your structure. And that's the difference between a product pusher and a capital advisor. Here's the final takeaway for the day. Bank loans, non-QM loans, DSCR, and SBA are not competing projects. They're tools available to our clients. And the question is not which one is best. The question is which one fits your situation best. And if you want a structure conversation instead of a rate quote, let's talk. My name's Bill Rapp. I represent Medallion Funds and I do mortgage and commercial capital advisory. That is it for the day. Please visit billrapponline.com to figure out how to get a hold of me. Love to talk to you more.